a few good customers who can say good things about you, because then they might give a positive word to other potential customers, kind of thing. Also, of course, if they're recurring, then they keep coming back. It's more reliable sales for you, and maybe less sort of a search costs, if you like. Right? If you have to keep finding new customers all the time, there's a lot of advertising expense, a lot of time wrapped up in sort of searching for customers. It's a lot easier if you know every week Bob's going to come back and buy something from you. Then it's a little bit more steady sales, and you don't have to maybe spend as much on the advertising trying to convince new people to switch to you. Okay, and this is, of course, could possibly be achieved, where's my mouse, by those, remember we talked about those switching costs, remember in Michael Porter's world, right? If you can get those switching costs that are to be really high, then your customers might be less inclined to switch to other vendors. So this is, again, reinforcing this idea of you want to get the same customer coming back again and again and again and again. Also, we want to have some ability to forecast credibly. Obviously, like if you have a brand new industry that never existed before, this is much more difficult than some industry that has a little bit of a track record. Okay. This also involves maybe like, have you read up on the industry numbers? In other words, the idea is that we want to know sort of how credible can you make those projections, these 5 to 7 year projections. I mean, ideally, what we want is internally generated funds. Okay? This, of course, is maybe more of a dream for early startups. What it basically says is, you need money, okay, to finance. And as we talked about on the previous slide back here, we need money. Give me money. I need money. Money, money, money. Okay? Internally generated means that we're making lots of cash, positive cash, from operations. Remember the cash flow statement, the 3 sections? Cash from operations, cash from financing, and what was the other one? And cash from investing, right? So that was the buying and selling of factories and physical assets. Well, remember the first one was the cash generated from operations. So this is that same idea coming back to haunt us. Ideally, we want to live in a world where our general operations, our main line of business, is making us a lot of cash. Sometimes you look in finance textbooks, they'll call this like, a plowback ratio. Right, so the company's making all this cash and they can plow it all back into the company, kind of thing, as opposed to the other option, of course, is externally generated funds. So this is where we go and sell shares, we borrow from banks, we have bond issues or whatever. The reason why internally is better is, of course, if you're issuing shares, then you're going to have all these pesky shareholders who want to own part of your company, might want to try to tell you what to do. Try to get, for instance, the shareholders, let's say, if it's putting, let's say, 20 or 30% equity, might want to have sort of conditions, saying like, I, shareholder, want to have a couple seats on the board to direct the direction of the company. Bondholders, again, will have claims on your assets, right? Banks could come and, let's say, take away your house if your house is put up as collateral, kind of thing. So there's a lot more risks involved bringing in all these outsiders. However, oftentimes, you have problems generating enough cash, and so you're forced to go outside. Okay, but in the perfect world, we'd love to have lots of internally generated funds, because that way, your house, your personal property is not encumbered, right? It's not being put up as collateral if you don't have debt, and also you don't have all these other people to answer to if you have equity. But being 100% internally generated might not be feasible. And of course, sustained growth, right? So we want to be in that good industry that is growing, okay? Right? Because again, that's that life cycle stuff we talked about, right? We want to be in something that's not, mature stage or declining stage, because that's probably an issue we want to eventually get out of. And the last thing is availability of exit opportunity. What this means is, at some point, the shareholders might want to cash out and get their money back. So is that going to be possible? As a shareholder, right, you might say, well, I don't want to be invested in this thing for 40 years. At some point, I want to retire, or I want my money so I can go buy a car or something, right? So there's opportunities to get out. Sometimes this could be like a public offering or something. Okay, so as I said, this is a slightly different way of looking at it. But again, what are our objectives? So this is basically management, right? Remember, the four major functions of management are planning, leading, organizing, and controlling, the PLOC or PLOC, the classical management, from a financial perspective. Okay? So from the point of view of the financial manager, we have, in this case, 4 criteria. And there could be other ones, as my other slides had, I think, 5. I think my 5th one had market. But again, for entrepreneurships, for entrepreneurial companies, of course, that's earlier stages, you probably don't have publicly traded debt or publicly traded stocks. So that's that's part of the reason why it kind of disappeared from my list. Because before, remember, I had the 5th one, the market value ratios. But again, profitability. Profitable companies tend to attract potential investors. Unprofitable ones won't. But also the second reason, of course, is if you're, let's say, the entrepreneur, maybe you have a job. And so now you're going to quit your job and go start this entrepreneurial business. Well, this business better be profitable, or you're not going to be eating a lot, you're going to have a pretty crappy life if it's never profitable, right? If this is going to serve as sort of an income generator for you. Liquidity, again, is, can we pay our short-term debts? Okay, so we talked about some of the ratios, like the current ratio, for instance. So as our bills come due, can we pay them off? And of course, the class examples are, can we pay our wage bill every 2 weeks, if that's how we pay, or every week, or however it's done. Can we pay it for our inventory, for our suppliers? Okay. Efficiency, again, is how well are we using our assets. So we're concerned about, people owe us money, are they paying us back 10 days, not 80 or 90 days. If we have inventory on the shelf, are we selling it? Or we don't want it sitting there for 6 or 7 months. So are we selling? Because if we're not, then maybe we're not buying the correct merchandise. Maybe we have an inventory purchasing problem. That the fashion is one way, and we're buying the wrong fashion. Stability is that sort of capital structure thing I mentioned from time to time, that Modigliani and Miller stuff. I think it's in chapter 20 of your textbook. Right? We're concerned about the debt-equity ratio. We don't want to have way too much debt, or the poor company is going to have all these things to worry about. Like, can we make these huge monthly payments to service our debt? And if we have way too much debt compared to equity, then we might have some problems with that. It creates sort of a stability issue. There's sort of what they call like a bankruptcy risks start becoming an issue. There is this process here, basically, again, of how to go about doing all these financial statement stuff. Right? This is basically, how do we go about making those pro forma statements? So again, we start with historical statements. That's more true for established businesses. For new businesses, we might look at industry averages, or the numbers of companies that we're comparing ourselves to.